Hi everyone, I'm Jesse Mackey, the Chief Investment Officer for 4Thought Financial Group. What I wanted to talk to you about today is a little bit about a particular strategy we offer called 4Thought Opportunistic Systematic Investing. And the reason I wanted to tell you about this is because we've had a lot of questions about it recently. In particular, this year to date in 2020, as of June 30th, we've had double-digit returns while the market continues to be down. The broader stock market, that is, continues to be down. So the questions that we're getting are, how are we doing this? So I want to give you a little bit of the background and give you a little bit of knowledge about how we go about doing this kind of thing. So there are really four different types of market environment that we look at as a firm that you can potentially capitalize on as an investor or defend against. You have the traditional bull and bear markets, which most people are familiar with. A bear market being a decline of 20% or greater from a record peak. A bull market being pretty much every other type of market environment, which is typically a rising environment or flat environment. Historically, those are the two ways the markets have been defined in terms of the market cycles and environment types. But we look at it a little bit differently. We actually break it down into four categories. And the two other types of market environments we refer to are something called the wolf market, which is a period of volatile asset prices without any real clear bull or bear trend, just to keep it simple. And you have something called an eagle market, which is an environment of rapidly rising or soaring asset prices with very low volatility. So if you break it down that way and think of it that way, one of the things we like to do with our clients and our investors' portfolios is devise strategies that are particularly well attuned to those four different types of market environment and actually actively adapt their portfolio as the markets change to try to capitalize on those environments. So this strategy I mentioned earlier called Opportunistic Systematic Investing is specifically designed to capitalize on the wolf market environment. Remember, that's the one where you've got a lot of volatility, a lot of ups and downs, but no real clear bull or bear trend. Now, it also just so happens that strategy tends to do well. The second best area in which it tends to do well is in the bear market, right? So that happens to be why it's doing so well right now, or it has done so well in the recent time period, because we had a bear market this year. If you look at the period from, I believe it was February 19th, if I'm not mistaken, was the most recent record peak for the S&P 500 to about March 23rd, if I'm not mistaken, was about the trough so far. You had a decline there of in excess of 30% over that time period. And since then, the market has rapidly rebounded. As of today, which is mid-July, we're nearing the record peaks again. So it's a pretty rapid rebound. So it's a very short time period for a bear market to manifest itself and then recover so quickly. Historically, it takes up much longer than that normally. So in some sense, this has some characteristics of a wolf market, that heightened volatility level. Typically, wolf markets have a shorter, we define them quantitatively, and a shorter drop, right, of less than 10% from a peak, followed by a recovery to that prior record peak is what we define as a wolf market, to keep it real simple. So this is, you can think of it as an excessive wolf market that ultimately turned into a bear and then recovered very quickly. So that environment was great for this particular strategy because it is designed to capitalize on volatility. So although our returns on that strategy year to date are in excess of 16%, net of fees as of the end of June, that is mainly because it is so well attuned for this environment. So there are other environments, for example, when you have an eagle market where this type of strategy will tend to lag significantly. Right? When you have rapidly soaring asset prices, any tactical manipulation you do within a portfolio is more or less going to hurt you for the most part. So because if you spend any time at all in bonds or cash, then you are going to miss out on that upside. So that's what you tend to get when you use an opportunistic strategy in a rapidly rising market. That has not been the case. If you look at the period from January 1st until June 30th. So, all right, that being the case, how are we doing this? How are we actually achieving these results? Because it's one thing to say you've designed a strategy that's designed for this environment. Another thing to actually capitalize on that environment. It's actually extremely difficult to do. Many people try to do this on their own. Many people try to, quote unquote, time the market, and are less than successful at it. Let's put it lightly. In many cases, they lose their shirts trying to do this. So it's extremely difficult. And the way we do this is what we use. We use something called unconstrained tactical asset allocation. And it's important. And what that means, just simply, is that we have the ability to go anywhere from 100% in cash to 100% in stocks, or any single type of stocks, or bonds, or any other asset class, or any mix thereof. Right? So it can be extremely conservative, extremely aggressive and optimistic, and anywhere in between. So, how do we make those decisions? It's important. This is what's the most important. We use algorithmic processes. Right? So, what that means is we have a string of proprietary formulas that we've developed internally that tell us what to buy and sell and exactly when to do it. And we get that information. We rerun these formulas or algorithms, right, at least daily, using brand new information that we get every day. So that's why we're able to do this consistently over time and to capitalize on the opportunities when they present themselves. So if you have a managerial firm or an investment manager or a retail investor trying to do this themselves, effectively, without that kind of process in place, that kind of algorithmic process, they are just guessing, right? It's just, it becomes emotional investing. They are buying when they should have sold. They're selling when they should have bought, right? It does not end well, right? So in order to effectively do this, you have to have a formulaic algorithmic process that is repeatable over time and that can systematically capitalize on the opportunities when they present themselves. So you have to have you have to leverage technology, computers, in order to do this. And not only that, it's not just anybody that can, it's not just any algorithm. It has to be the right algorithm. So these processes, we gradually developed over years, and calibrated them, right, so that they are attuned to the way the markets move, right, to put it simply. The way the algorithms work is based on probabilistic analysis. All right, so that is, if you think of probabilistic analysis, I'm talking about probability distribution curves. Think about the bell curve, and the bell curve tells us that the certain probability of an event or a certain historical probability of an occurrence of that event, and what we can, and thus, essentially what we can hope to expect in the future. Doesn't mean that's exactly what's going to happen. The shape of the curve can change, and in fact, it does change every single day. Every single day that new data is available, we rerun these and reshape these curves and remeasure them. All right. So as a result, we have new data and new decisions to make every single day. So that is, without going too much in depth, that is effectively how we make our decisions. We don't always have outstanding results in every market environment, but in these types of market environments where you've got the heightened volatility and a difficult environment in which to invest, then this type of strategy tends to do very well. In other environments, you would need a different strategy. Right? So those are something we would offer separately from this particular strategy. But the opportunistic systematic investing approach or strategy that we offer has been particularly well adjusted for this most recent environment. So if you're interested in learning more about this, or if you're interested in reading some material on this, or getting in contact with us to potentially invest, that's something we'd love to discuss with you. Obviously, you can contact us anytime you'd like at 516-300-1617 or at info@4tfg.com. And don't forget to subscribe to our blog feed and to our YouTube channel. Thanks, and talk to you soon.